Right. So, what is the disadvantage for running sole partnership and a partnership? Um, the first one is unlimited liabilities. Okay, the liability issue is always a primary concern for running a firm. So unlimited liability basically means if your investment in the firm is $10,000, however, you are running $50,000 liabilities, and then you are under the water. Okay, so let's say this is your investment of the firm. Okay, and that basically the assets value of the firm. Right now, you got a $10,000. However, your debt on your shoulder or liabilities, you can call that as well, is a $50,000. Okay, so basically, if you liquidate your entire firm, okay, I think I should zoom myself in a little bit. Just hold on one second. Okay, so if you liquidate your firm, you get a $10,000 cash, and you debt to pay for the debt. You can only kill only part of it, so you still have a $40,000 debt left. All right, so even after you liquidate your firm, you can still not satisfy the debt. So what do you need to do? You're probably gonna sell your own car, your own personal belongings, or you may even have to sell your house and sleep on the street. Okay, so that's the major disadvantage for running the partnership and partnership, because when the company goes bad, in order to pay off the debt, you could possibly sell your own personal belongings and the worst case sleep on the street. All right, so that's the major disadvantage. The second disadvantage here is limited life for the enterprise. So if a partner got killed or died or just leave the business, then the entire partnership ceases to exist. Okay. Another disadvantage is it's difficult to transfer ownership. All right. So if you want to sell your business to another person, then you have to uh, look for the buyer, and that buyer happen to have the same interest in the business, would like to offer the price you want to buy the same percentage share of the business. You can see that the entire process would be very hard. If you are running a corporation, however, okay, not partnership, a corporation, then you can just buy and sell stocks in the open market, which is very easy transfer of ownership. Okay, so back to the partnership and partnership. Another disadvantage is it's hard to raise large amounts of cash. Okay, it's hard to raise large amount of cash um, because the partnership have a limited access to the capital market. All right, so if you want to sell your equity, it's not an easy job. So what about the advantage for running this kind of businesses? One major advantage is it has less regulation. If you want to register for a partnership, you just go to your city or your town, um, and then apply a business license, and then you need to register online, or you can go to the state office where you do your driver license, and get your business registered. All right, and then you can get it done within hours, or if you register for partnership at the state of Illinois, it takes about 10 days to get your company registered. All right, and there's no corporate tax. You pay you pay income tax when you are running a partnership and individual partnership. All right, and that's a major advantage. In contrast, if you're running a corporation, you not only pay corporate tax, but also you pay income tax, both taxes. All right, so now let's take a look at corporation, our major forms of a business. Let's see how I can place my stuff right here. Okay, so you guys can see it better. So the corporation basically is a standard method for raising large amount of cash, just like Apple, not the fruit, but the company which has the largest capitalization in the entire world. Basically, that's the biggest public firm. So when Apple was the first started, it was in a garage in somewhere California when Steve Jobs and his partner first developed the idea of a modern computer. Okay, so the form of business at that time was a partnership. Okay, it involved Steve Jobs and the other partner. And then they decide to develop the firm, and of course, they want a large amount of capital from investors so they can buy more computers, buy more equipment, hire more research personnel. So they need to get access to the abundant capital market of the United States. All right. So the first thing they need to do is to convert their form of business from a partnership to a corporation. That way, they get access to the capital market. So basically, they could get connected to all these investment firms, like a Merrill Lynch, like a Morgan Stanley. And you can only get to them if you are a corporation. Because if you are a corporation, your equity is basically divisible. Okay, so we're not talking about half of the business as a whole chunk. Instead, we're dividing all the equity into small pieces, like $40 a share, $60 a share, and that could make the shares more easily to be sold to another buyer. Okay, which is a very easy process for transfer of ownership. Okay, and these are all the other advantages for running a corporation. Okay, you have a limited liability. That's another huge issue for running a corporation. As I raised the example right here, so if your business is worth $10,000 and you are running $50,000 debt, so if you are running a partnership, you have to pay the rest of $40 debt. Okay, you have to liquidate your house, liquidate your BMW and whatsoever. However, if you're running a corporation, if you have a liquidate your entire firm and then you pay off $10,000 of a $50,000 debt, you still have $40,000 debt, then you're not responsible for it at all. Okay, so that's the beauty of running a corporation. Your liability is limited, okay, to how much ever your investment in the firm or how much ever the firm is worth, and not limited to the level of debt. Okay, so if you have a more debt than the worth of the firm, you're not responsible for it. Okay, you don't hold liabilities for the actual amount of money for debt. Okay, and also if you're running a corporation, you have the corporation has a perpetual life. After Steve Jobs died, Apple did not die, right? Because the ownership could be transferred to another generation of equity holders. And also you have a transferable ownership, just by buying and selling stocks in the market, then the ownership is transferred. So what about the disadvantages for running a corporation? The major one is double taxation, okay? And we're not talking about a corporate tax, and sometimes the corporate tax rate could be lower than the income tax rate. We're talking about two taxes being paid at the same time. One is corporate tax, and another is tax on earnings. So if you are running a corporation and you make some earnings, okay? So let's say you have a sales, you deduct costs, and you deduct the depreciation, and then you have an earning before tax, interest, and taxes, okay? So this is also called operating profit. And then you pay interest, and then you pay taxes, okay? This is called a corporate tax. Corporate tax is usually 34% to 40%, depending on the income level. And after you pay corporate tax, you get a net income. And the net income would be the profit that is distributable to the shareholders, okay, or the owners of the firm, okay? So the net income could be in the form of a dividend. So if you hold company stock, you receive a dividend, okay? And if you receive dividend, you would pay 25% dividend tax rate, okay? So you pay tax on that. You can see, well, you pay corporate tax rate here, you also pay dividend tax right here. All right, so that's called a double taxation. Another form of net income could be retained earnings. Okay, retained earnings. So basically, the firm does not pay out the net income as dividend. Instead, the firm saves the net income into its own saving account, and that saving account of the firm is called a retained earnings. So what happens? What if you keep saving more and more money? The result is the stock price would go up. Okay, if the firm keeps saving money, then the firm is worth higher and higher. Then the stock price would go up. Okay, so as a stockholder, if you buy Apple's share, we'll see the stock price of Apple is going up. You're happy, right? Because you make money. And when you make money from a price appreciation, that is called capital gain. Okay, that's called capital gain. When you buy it at $100, you sell it at $200, you make $100 profit. That is called $100 capital gain. And then the IRS will not let you go. You have to pay capital gain tax. Okay, so one way or another, no matter how net income is distributed, either 100% dividend, 0% retained earnings, or 0% dividend, 100% retained earnings, or 50-50, 30-70, 40-60, you always pay taxes. Okay, you either pay dividend tax or capital gain tax. Okay, for the net income or the profit you make as an investor of the firm or as an owner of the firm. Okay, that's the second round of tax. The first round of tax happens right here. After you make the earnings, you pay interest, and then you pay corporate tax. You see, that's the number one tax you pay, and this would be the number two tax you pay. Okay, that's when you're running the corporation. Well, that's why Warren Buffett actually several years ago said that his secretary pays higher tax rate than himself. All right, so Warren Buffett is a very successful investor in the world. Well, his assets is basically hundreds of billions of dollars. So basically, he told the media that he is paying either this tax rate, which is lower than the income tax his secretary is paying. Well, that argument was hotly debated. A lot of financiers said, when Warren Buffett said his tax rate is low, this could be 25%, whereas his secretary has an income tax rate of, let's say, 28%. Right? Assume she is a single, and she make like $100,000, 28, right? So you can see that this income tax rate is higher than the dividend tax rate. Okay, so that's basically the statement of Warren Buffett. But Warren Buffett really ignored the corporate tax his company has paid. Okay, his company is called Berkshire Hathaway, headquartered in Omaha, Nebraska. Okay, so before Warren Buffett make some earnings, his company has already paid corporate tax. Okay, which is this is called a double taxation. All right, so that's enough for this topic. Well, you know that double taxation is not a good way to encourage businesses, right? The Congress realized this issue, and in the United States, the Congress actually approved a business form called S corporations. S stands for small. Okay, so that's a way to encourage the small businesses. If you have a very limited size of business, you can claim yourself as S corporation. The benefit of S corporation is you are not paying double taxes. You don't pay corporate tax. Instead, you get a taxes as a partnership, which means you only pay income tax. Sounds pretty good, right? But that only applies to S corporations or small ones. The regular corporation like a Coca-Cola, Nike, Ford, these are all C corporations. Okay, so you have a C corporations. These are regular corporations, and S corporations are small corporations that only pay income tax. So C corporation pays double tax, S pays single tax.